While expectations are that growth in the U.S. economy will bounce back in the second quarter, the evidence from the MNI Chicago report shows activity weakening from an already low level. The MNI Chicago Business Barometer fell 1.1 points to 49.3 in May, the lowest level since February and the sixth time the barometer has been in contraction over the past 12 months. Following the decline in April, the latest results show activity stumbling in the second quarter, following only moderate growth in Q1. Barring a solid revival in June, quarter two could be the weakest outturn since the fourth quarter of 2015, given that the April-May average stood at just 49.8. The barometer's decline was led by a 6.6 drop in production and was accompanied by a mild setback in new orders, with both components falling below the 50 neutral level. While these were the only two components that declined between April and May, 4 out of the 5 components that comprised the barometer were in contraction in May. Only supplier deliveries stood above 50. The fall in production took it to the lowest since February, while new orders declined to the lowest since December 2015. In contrast, order backlogs bounced back 9 points, but still failed to recoup all of April's large loss, and it remained below 50 for the 16th consecutive month. Employment rose marginally but failed to move out of contraction, where it has been in 10 of the past 12 months. Firms ran down stocks of finished goods at the fastest pace in more than 6 years in May, and while rebuilding over the coming months could support output, the underlying message appears to be that businesses are not confident about the outlook for growth. Inventories tumbled 11.7 points to 37.9 in May, the lowest level since November 2009, and marking its 7th consecutive monthly contraction. The lack of confidence was underlined by the answer to this month's special question, which showed 68.7% of panelists did not plan to increase business investment over the next 6 months. Supplier deliveries were unchanged on the month following a solid rise in April that left the indicator at the highest since October 2014. This suggested some bottlenecks and shortages in the supply chain. Additionally, times to source production material lengthened to the highest since August 2014, and that for capital equipment was the longest since June 2006. Prices paid decreased slightly, but this was after having picked up more than 10 points in April amid the recovery in oil prices and increases in other raw material costs.